Hey everybody, it's Chris Buteau with Cleveland Street Mortgage, and today I want to do a quick comparison of FHA versus conventional loans. They're both good products for low down payment. When you have, let's say, 3 to 3.5% down, you're limited on the amount of funds that you have. Both of these products can solve that down payment problem. But how do you compare those? Why would you go one versus the other? And the short answer is if you have good to excellent credit, conventional is going to be far and away the better option. And as your credit gets closer to, let's say, fair to challenge credit, then maybe that's going to tip toward FHA. But even then, not always clear cut, depending on exactly where your credit falls. So let's look at the excellent credit scenario first. Here I have somebody's a $600,000 purchase, and we've got, let's say, 3.5% down or 3% down. We're going to say he's got 740 credit, and we're going to look at various categories or various features of the FHA and the conventional loan and of the lending process in general to compare these loans, the relative benefits, advantages of each. And let's just start with loan cost. Loan cost. The FHA loan has a one-time funding fee of 1.75%. On our $600,000 purchase, that adds about $10,100 to your closing costs. So that's going to be a clear advantage conventional in this situation, because conventional doesn't have that type of an upfront cost. Now, this funding fee is financed into the loan, so you're not bringing that much extra cash in, so it doesn't require a lot of extra cash, but it is a real cost to you. You are incurring that cost. It is added to your loan amount. It does eat into your equity. So clear advantage here to the conventional loan. Cash to close, we're going to get a slight benefit to conventional here as well. The reason for that is because conventional requires 3% down, FHA is 3.5% down. So if you're really struggling to kind of leverage that amount of cash you have into the most property, probably conventional is going to be your best bet there. And again, because the funding fee of FHA is financed in, even though the closing costs are much higher, and the cash to close difference is not as great as it otherwise would be. Principal and interest, I'm gonna call this a toss-up. Now, FHA is actually about $43 a month less when you're doing principal and interest and mortgage insurance all in. And I'm going to call that a toss-up because in the grand scheme of things, $43 a month is just not that much when you're comparing these two loans, with the total monthly payment that you're looking at. Not enough really to kind of give it a clear advantage one way or another, so we're going to call that a toss-up. And part of the reason for that is because here's kind of a key element. Remember, FHA mortgage insurance is generally never removable. Now, there are some situations where you can remove FHA mortgage insurance, but that requires a lot more down payment, and you're generally not going to want an FHA loan if you have a lot of down payment to begin with. So, for practically speaking, FHA mortgage insurance is usually going to be non-removable. So this is a permanent feature, whereas the conventional mortgage insurance is potentially removable. Now, you should never assume that that's guaranteed, because it's not. But if you have market appreciation and you pay down your loan a little bit and you get to the point of you get 22% equity down the road, you can ask to have that removed. And my clients generally have a lot of success if they really have the equity of having that mortgage insurance component removed. And so you see, this stays as a permanent part of that payment. This goes away. And now that $43 a month advantage that FHA has now becomes a $200 a month advantage to conventional. So again, that's just the FHA removable option. Market perception. This also is going to give the nod, strongly really to conventional here again for a couple of reasons. When you finance a loan with FHA money, the seller has to sign what's called an amendatory clause, and the amendatory clause says that no matter what else we agree to, no matter even if we explicitly agree to the contrary, you cannot require the borrower to stick with the deal, the buyer, if the appraisal comes in low. You can't force him to stay with the deal. You have to refund his earnest money, and you have to let him walk away from the deal. And that's a very challenging proposition in a market such as many markets, across the country are right now. Certainly in our market in the Seattle area, super hot sellers market right now, and that means prices are going up. And we haven't seen a lot of problems with appraisals, but it's not unlikely that that could occur. And a seller just is not necessarily going to want to take your deal over somebody who can say, no, I'll waive the appraisal. If the appraisal comes in low, I'll still take the deal. You can't require that on an FHA loan. And so that's a strong nod to a conventional in terms of market perception when you're going, to make a bid in a competitive situation. And then just a general prejudice. I mean, FHA has been around for a long time. They've been through a lot of iterations, and there have been times when they're not that hard anymore, but they are a little more persnickety. And so some of it's just prejudice from the old days when they were a lot harder and a lot more challenging to do. So your conventional loans with 3% down are generally going to be considered more favorably, again, by your sellers. Property types, again, this is a nod to conventional. Property type, they'll essentially accept all types of property types. And yeah, manufactured homes will be different, underwritten slightly different, but generally they're going to take all property types. FHA, for example, you can't finance a condo with FHA unless it's an approved FHA condo. And the majority of condos that you will find out there aren't, typically in my market anyway, aren't approved by FHA. And so that limits the amount of properties that you can make a bid on. And then there may be some additional hoops for manufactured homes, et cetera. So that's a nod to conventional as well. And then kind of the one area where I think FHA clearly has an advantage is max price range. And the reason for that is, again, here their payments about $43 a month less, and their debt to income ratio allowances. So that's, when they're calculating your capacity to handle the loan, they're dividing your total monthly expenses divided by your gross monthly income. And FHA, usually conventional, maybe you're going to be 45, maybe 50% max DTI, whereas FHA will maybe let you go to 58. So I would say that that's a nod to the FHA, and really the only nod. Now let's go to the fair credit scenario. And this is a little bit more mixed. Again, you're going to see most of the advantage goes to conventional here as well, but it's not nearly as pronounced. So now this is someone who's got a 680 credit score, fair credit, same $600,000 purchase price, 3.5% down. Funding fee is exactly the same. Cash to close, same again. The extra $10,100 cost, 3% versus 3.5%. That's not affected by the credit score. And so those are still clear nods here to conventional. Now, FHA gets the nod on the monthly payment. Now, this is even though, eventually this $461 mortgage insurance component could go away, and that could swing the benefit back into the conventional column. But that's into the future, and the difference is fairly significant. In the beginning, $356 a month less for FHA than the conventional, and that's because FHA is essentially not affected by your credit score. Now, there may be some credit ranges where it starts to kick in, but anywhere between 740 and here 680, zero change on your mortgage insurance component, on your interest rate, and so your monthly payment on an FHA loan, when you do have fair credit, is going to favor the FHA loan, because conventional is significantly impacted. Your monthly payment, your mortgage insurance is significantly impacted by your credit scores there. Again, here's your MI components, and this is still not removable. So FHA is going to be permanent generally, whereas this is potentially removable. So that could, again, be a huge benefit in the future. And then everything else is really the same. The market perception, same thing. The mandatory clause, general prejudice against FHAs is going to swing in favor of conventional. Property types, again, only approved condos. Manufactured homes maybe have some additional hoops you have to jump through on the FHA. So that's, again, going to swing to the conventional side. And then here, this is going to be more pronounced. The max price range is going to be more pronounced at the lower credit scores. And the reason for that is because look at this monthly payment, $346 a month less that you're getting, that you have to calculate your debt to income ratio with, than if you were to use a conventional. And so just even if they were both to allow the same debt to income ratios, but you combine that with the fact that FHA allows for higher debt to income ratios up to 58%, you might qualify for a significantly more house with an FHA when you have that kind of modest, fair to modest credit. So that's it for now. Hope that helps, and thanks so much.